Imagine this. You finally retired after a lifetime of hard work. You book a one-way ticket to Mexico, ready for a life of sunshine and beach walks, funded by your CPP, OAS, and GIS. But just 6 months in, two of those benefits vanish completely. The other hit with a surprise tax. Most Canadians don't realize exactly what happens to their government income when they move abroad. In this video, I'll explain what still gets paid out, what gets taxed, and what stops completely. And to make it easy, I'll give you a one-screen cheat sheet at the end of this video showing exactly how CPP, OAS, and GIS behave when you leave Canada. So here's the hard truth, what you lose first. What happens to the Guaranteed Income Supplement, or the GIS, if you move abroad? Well, it's not so guaranteed. I have some bad news. The GIS is not portable. It's a monthly benefit meant to support low-income seniors who live in Canada, and the government is very clear about this. If you leave Canada for more than 6 consecutive months, your GIS stops. This rule applies even if your income stays low and you continue filing Canadian taxes. So meet Jean, a 71-year-old retiree in Vancouver who was receiving both CPP and GIS. After deciding to move to Mexico, she was surprised to find that her GIS was terminated a few months into her move. Why? Well, because she was outside Canada for more than 6 months, and that automatically disqualifies her. According to the Government of Canada, your Guaranteed Income Supplement payments can stop if you leave Canada for more than 6 consecutive months. And here's the key. There's no social security agreement which will protect your GIS. GIS is strictly tied to your physical presence in Canada. So for a GIS reality check, even if your income threshold is low enough and qualifies for the payments, GIS won't follow you abroad. So if GIS is a critical part of your retirement income, make sure you consider this before relocating. You might need to delay your move, adjust your budget, or explore other income options to replace the loss. And here's a pro tip, a residency trick. Some retirees maintain part-year residency in Canada to keep their healthcare and tax status. It's the classic snowbird move. They spend winters somewhere warm like Florida or Mexico, but make sure not to stay outside Canada for more than 183 days in a calendar year. Now for some good news, let's talk about what you get to keep. So what happens to your Canada pension plan or the CPP benefits when you become a non-resident? First off, it's important to know that CPP is based on your contributions during your working life in Canada, not on your residency. And that's great news if you're thinking of retiring abroad. This means that your CPP benefits will travel with you. The amount you receive is the same whether you're living in Canada or somewhere sunny like Portugal, Thailand, or Costa Rica. Take Linda, for example. She worked in Toronto for 35 years, paid into CPP the entire time, and now she's planning to retire in Spain. Even though she's leaving Canada, her CPP payments won't change because they're based on her contributions, not where she lives. Think of your CPP as like your faithful golden retriever of retirement benefits. It's loyal and it goes everywhere with you. That said, there are a few key tax considerations once you're outside Canada. Your CPP payments may be subject to withholding tax if you're considered a non-resident. If Canada has a tax treaty with the country you're moving to, that tax could be reduced or even eliminated. Without a tax treaty, you could face a 25% withholding tax on your CPP payments. For example, if you're moving to the US, there's a tax treaty in place, and you may avoid withholding tax entirely. For other countries, you might not be so lucky. The key here is to review your destination's tax treaty with Canada carefully. These agreements vary widely and can make a significant difference in how much of your CPP you actually keep. Canada also has something called a social security agreement with over 50 countries. And this helps with avoiding double contributions, ensure your CPP coverage continues uninterrupted, and coordinates benefits if you worked both in Canada and abroad. And there's more good news. If you're receiving CPP survivor benefits or child benefits, those also continue while living outside Canada. As for actually receiving your CPP payments, you can have them direct deposited into a Canadian bank account, or in many countries, you can receive them in local currency through a local bank. Or they could even be mailed as a check in Canadian dollars if needed. And lastly, while your CPP amount doesn't change, your new country might tax those payments a little differently. And it's really smart to check local tax laws so you're not caught off guard. The wild card. What happens to your old age security or OAS benefits when you retire abroad? First off, it's important to understand that OAS is based on residency, not on your work history or contributions like CPP. To qualify for OAS while living outside of Canada, you must meet specific residency rules. The key rule is this: you can receive OAS abroad if you've lived in Canada for at least 20 years after turning 18. If you meet that threshold, your monthly OAS payments will continue even if you're living permanently overseas. Take Pedro, for example. He moved to Canada at age 25 and lived there for 30 years before retiring to Spain. Because he met the 20-year residency requirement, he continues to receive his full OAS payments while living abroad. Think of OAS like a loyalty card. It only works after 20 plus visits or years. But what if you don't meet the 20-year rule? Your OAS could stop if you leave Canada for more than 6 consecutive months after the month of departure. That means if you lived in Canada less than 20 years and leave the country for more than 6 months, your OAS will be suspended. You'll have to return to Canada and re-establish residency before you can start receiving it again. But don't worry, there are a lot of exceptions though. You might still qualify for OAS abroad if you lived or worked in a country that has a social security agreement with Canada, and the combined time you lived in both countries is at least 20 years. So this is an important point: the years lived in another country do not increase your OAS amount. They only help determine if you qualify to keep receiving it. Now let's talk about taxes. Your OAS payments are considered taxable income, even when you live abroad. However, federal tax isn't automatically withheld each month. You can request voluntary tax deductions by logging into your My Service Canada account or filling out this form. If you live outside of Canada, your OAS may also be subject to a non-resident withholding tax. The default rate is 25%, but if you live in a country with a tax treaty with Canada, that rate may be reduced or eliminated entirely. For example, if you move to the US, Canada's tax treaty means your OAS is not subject to withholding tax. But if you move to Germany, on the other hand, Canada does have a tax treaty in place, but it does not eliminate withholding tax on your OAS. Instead, under Article 18 of the Canada-Germany Tax Treaty, Canada may tax public pensions like OAS at a rate not exceeding 15%. So you might end up paying about a 15% withholding tax on your OAS payments while living there. While abroad, you'll receive an NR4 tax slip each year instead of a T4 if you've lived in Canada, and you'll need to include it when you file your annual tax return. And remember, you must continue filing a Canadian tax return every year to keep receiving your OAS while abroad. And here's an OAS pro tip: if you're concerned about hitting the income threshold for the OAS recovery tax, also known as the clawback, which begins at $93,454 in 2025, consider managing your taxable income through RRSP withdrawals, pension income splitting, or deferring OAS to age 70 for a higher benefit. I'll go over that in more details now. Here's some planning strategies to maximize benefits. For an example, meet Anita, who's 67 and retiring to Portugal. She just retired after spending 22 years living and working in Canada. She qualifies for a CPP and just became eligible for OAS because she crossed a 20-year residency threshold. She's also been receiving GIS due to her modest income. She plans to move to Portugal, which has a social security and tax treaty with Canada. And here's what happens when she moves. Her CPP continues without interruption. Thanks to the tax treaty, she pays a reduced 15% withholding tax on her CPP. Her OAS also continues since she met the 20-year requirement, and had she moved a year earlier, she'd have received nothing until returning to Canada or qualifying through the treaty. Her GIS stops after 6 months. No matter what her income level is, her GIS requires ongoing Canadian residency, and there's no workaround. So here's what Anita did right. She delayed her move until she hit 20 years of residency, and she chose a treaty country like Portugal to reduce tax. And she also started planning early so she could manage her budget without GIS. Tying it all together, your travel companions. Here's a simple way to remember how these benefits behave when you retire abroad. Think of CPP, OAS, and GIS like your travel companions. Your CPP is your ride or die friend. You've worked together for years, and now that you're retiring, they'll stick with you wherever you go. Colombia, Germany, Thailand, France, Mexico, CPP's already packed and waiting at the gate. Just watch out for your tax at the destination. They may charge a fee to let your friend in. OAS is more selective. They'll only come if you built a strong enough relationship, meaning 20 plus years of living in Canada after the age of 18. If not, they might just stay home unless you've got mutual friends in countries with a social security agreement. And GIS, well, that friend just loves Canada. They're generous while you're here, but once you leave Canada for more than 6 months, they'll totally ghost you. There's no treaty, no workaround, and not even a goodbye. So here's a cheat sheet for your CPP, OAS, and GIS and what happens to them when you leave Canada. You can screenshot this, pause it here so you don't forget. Here's a couple other pro tips. Consider drawing down your RRSPs before becoming a non-resident. Also make sure to plan for private healthcare. Provincial coverage ends after 6 to 7 months. There's a lot more to retiring abroad than sunshine and lower rent. The financial rules change fast, and the consequences can be very expensive. At Blueprint Financial, we specialize in helping Canadians make smart, tax-efficient moves overseas. Head to our website to get the full picture, and if you found this helpful, please like and subscribe. There's way more to explore, and we're just getting started.